The most dangerous moment is over. The Federal Reserve's faucet has finally been turned down since the U.S. banking crisis erupted earlier this month. The Fed has been playing an extremely awkward role, unwinding its balance sheet, as originally planned, while simultaneously working through the discount window and the newly launched Bank Term Funding Program, BTFP. Waiting for tools to inject blood into the banking industry. In other words, the Federal Reserve is like a swimming pool manager. On the one hand, it needs to pump water from the pool, as in the past half a year. And on the other hand, it needs to meet the needs of banks under the current state of emergency, and completely open the tap on the other side. In the first 2 weeks after the crisis, taps were apparently pumping far more water than pumps were pumping. However, in the past week, the situation seems to have finally bettered a little. The latest balance sheet data released by the Federal Reserve on Thursday showed that as of the week ended March 29, the size of the Fed's balance sheet fell to $8.706 trillion from $8.734 trillion in the previous week, a modest decrease of $27.8 billion week-on-week. This is also the first time that the size of the Fed's balance sheet has returned to contraction after the outbreak of the current U.S. banking crisis. In the first 2 weeks of the outbreak of the crisis, the size of the Fed's balance sheet has expanded significantly by nearly $400 billion, which is almost equivalent to nearly 2/3 of the size of the Fed's balance sheet reduction in the past half a year. Fed's emergency lending to banks falls according to relevant balance sheet details provided by the Federal Reserve. The U.S. banking industry has reduced borrowings from the Federal Reserve's to credit facilities in the latest week, indicating that liquidity needs may be stabilizing. Borrowing balances at U.S. financial institutions totaled $150.6 billion in the week ended March 29, down from $163.9 billion the previous week. Of that outstanding borrowing at the discount window, the Fed's traditional credit facility was $88.2 billion, down from $110.2 billion a week earlier and a record $150.9 billion earlier this month during bank troubles. Discount window borrowing is the Fed's main source of emergency credit to thrift institutions. These loans can be deferred for up to 90 days, and the discount window accepts a variety of collateral. Borrowing balances under the bank's Term Financing Program BTFP were last at $64.4 billion, up from $53.7 billion the previous week. BTFP officially opened on March 12, after the Federal Reserve announced the launch of the funding program following the collapse of Silicon Valley Bank and Signature Bank. The data suggest that policymakers' efforts to contain the contagion after the U.S. and European banks exploded this month are starting to bear fruit. Though banks' lending remains significantly higher than typical in times of low stress, Jefferies economists Thomas Simons and Tom Markowska pointed out that, after the dust settled in the banking industry this week, the report brought some relief that the situation at least did not deteriorate. In other data, the Fed's bridge bank loans to the Federal Deposit Insurance Corporation (FDIC) edged up to $180.1 billion in the week ended March 29, from $179.8 billion the previous week. The Federal Reserve's temporary repurchase agreement facility for foreign and international monetary authorities used by foreign central banks fell to $55 billion in the previous week. This arrangement hit a record high of $60 billion. In addition, in the past week, the US dollar liquidity swaps used by the Federal Reserve were only $585 million, of which $100 million was used by Swiss banks and $85 million was used by the European Central Bank. Has the most dangerous moment passed? TD Securities strategists Priya Misra and Molly McGowan said that the reduction in usage means that the liquidity position of banks has improved. but the situation is still uncertain at present. It remains to be seen whether the outflow of funds from U.S. bank depositors has shown signs of substantive easing. According to data released by the Federal Reserve on March 24, in the week ended March 15, U.S. bank deposits lost a total of $98.4 billion, a year-on-year decrease of 5.8%. Among them, deposits in small U.S. banks fell by $119 billion, the largest drop since March 2007. The next batch of data will be released this Friday, March 31. Uncertainty over the collapse of a Silicon Valley bank earlier this month has sparked massive outflows from regional U.S. banks such as First Republic and Westpac. People familiar with the inflows at top financial institutions said over the weekend and stock prices plummeted. But that has improved since around March 16. The fund inflows of U.S. money market funds announced overnight may also provide some reference money. Market funds have been getting an influx of money lately, largely as savers pull money out of U.S. banks. About $66 billion flowed into U.S. money market funds in the week ended March 29. According to the latest data from the investment company Institute released Thursday, the weekly inflows nearly halved from last week's $117.4 billion, but still brought total money market fund assets to a record nearly $5.2 trillion in the 3 weeks ended March 29. Money market funds saw inflows totaling about $304 billion.